Global. I work with All Steel and Gunlock. Thank you for joining us today. Super excited to have Spencer back. He's the chairman of the Americas for Research and senior economic advisor for CBRE. I think we last saw him in September. I was thinking it was a couple months ago, and Patrick, our chair of programs, had to say no. I think it's just been a warp speed year, some of the longest days ever, but I feel like the year went by very quickly. Unfortunately, I hate when I'm already seeing people say, all right, I'm ready for 2022, but we'll let Spencer talk to that. We're not going to go over Zoom housekeeping rules. I think you all know we've got you in mute. Stay muted. If you have some questions, throw them in the chat. We'll try to address those, I think, at the end. Right, Patrick?
Yes.
I think we can flip to our next slide. Do we have our sponsor slide in there? There we go.
We do.
We always thank our sponsors. We do what we do because of all of you. Thank you so much for your continued support. We are still in our sponsorship drive, so if you are interested in renewing, please reach out to Lori Acuna or Dawn Regal, who lead that committee, or any one of us involved in the board, and we can help you on that front. I think next we've just got like our list of upcoming events. It's a pretty busy January. All good things, just get to our website and sign up for the events that you wish to attend. I'm also just going to make a note that we're going to be sending an e-blast out shortly with our call for nominations for our board. This is the time of year when we put together our new board, which goes into effect April 1st. So be on the lookout for that. If you're interested in getting more involved in the board and you're a member, reach out to any of us. Me in particular, I'm happy to help guide you in that process if you have interest. I think that, and one last thing, I think we're torturing a lot of you with our real awards. We have not announced our winners yet. So stay tuned, those will roll out through social media. We are working on that, just making sure that we get it right because it's a different format this year. So thank you for your patience on that one. Hey, I'm gonna turn it over to this guy. I'm gonna give you Spencer. He's gonna talk about, this year, maybe a little bit of last year, and I hope it's some good stuff. And we need to send him some eggplant Parmesan.
Well, thank you, Lauren. And if I have time in today's presentation, I will tell people why that jersey got me a free glass of scotch at Dodger Stadium. It's a long story, but it's a story for maybe later in today's presentation. But to begin this presentation on the right note, I want to go back in time for about a year and show you the Why Chicago video I showed last September, because notwithstanding the fact it's a year and a half old, I still have the same optimism for Chicago in the future. So Brian, let's start with the video.
Chicago is one of the great cities in the world. When I look at any city, I look at three basic factors: talent, infrastructure, and foreign money. And Chicago has it all. Chicago, for the 6th year in a row, was the #1 city in the United States for corporate relocations. It is an inexpensive option compared to many of its coastal peers, New York, San Francisco, and Los Angeles. Chicago is a city on the rise, and let me tell you why. When I look at any market, my #1 factor is talent, and Chicago has plenty of it. #1, they've had enormous population growth, with their urban core growing almost 50% since 2000. #2, they have one of the most highly educated workforces in the United States through their universities and people moving here. Job growth, and it's not just any job growth, it's high quality job growth, as Chicago has one of the strongest tech sectors in the United States, but I would note it's also one of the most diversified job growth sectors, with no one industry dominating its city. Innovation is also a major sector within Chicago, as we're seeing over 300 new companies being formed a year, drawing in almost $2 billion of new venture capital money. Chicago is growing from a talent perspective, and the money and investment is following. One of the great advantages of Chicago is it's much more affordable than many of its big city peers in the U.S. And this affordability shows up in two basic ways. #1, the wages of employees are significantly lower in comparable industries than those cities. But in a commercial real estate standpoint, the cost of rents are much, much lower here, anywhere from 1/2 to 1/3 as much as they might be in some of its big city peers. Because of these cost advantages, Chicago is being discovered by foreign money from Germany, Canada, and even Asia to take advantage of both the low-cost investment and the high-quality workforce. In addition to that, Chicago has tremendous infrastructure, and the infrastructure is not only its two major airports, but also the area that many Chicagoans may complain about, your subway system, your train system, which might seem old or rusty. Let me tell you something. It is irreplaceable, and it is an enormous competitive advantage for Chicago. The last thing I would mention is its central location in the United States, which is a benefit not only from a get from here to there standpoint, but in particular in the industrial and the shipping space, where I think Chicago is enormously competitive. Like many big cities, Chicago is having issues with both crime and taxes that have gotten the attention of many domestic and foreign investors. From our perspective, the crime issue has actually gotten better, as crime has been reduced by about 15% since 2016. While there has been concerns about rising taxes at both an income tax and property level, we believe these increases should not impact your investment decisions, as Chicago still remains the lowest cost investment option of any of its big city peers around the United States. So talent, infrastructure, foreign money, a city on the rise. Why Chicago? That's why.
Thanks, Brian. You can kill the video. All right, that's it. Thanks for having me. But the bottom line is this. I'm going to start in a positive, and then I'm going to go right back to the beginning of where we're at. The future of Chicago is, was, and always will be bright. And it's bright because of all the factors I mentioned in that video. So when I talk macro, micro, and some of these challenges, just remember it's wrapped in a glossy packaging that Chicago has a great future for the reasons I laid out: talent, infrastructure, foreign money, only going to increase because of its attractiveness overall. But let's take a step back for a moment, and I want to start with the events of last week in Washington. And certainly hard to put a silver lining on the challenges we face there, the impeachment of the president, but I will put this bow on it. It is a sign of finality. It's over. We're moving forward. And I think that is the most important way to look at it from an economic perspective. And I think the stock market and the bond market have voted that way. You can see the record highs in the stock market. The bond market is 10-year treasury is moving up. And why? Because they are confident in the future of the United States over the next several years for having a stable political environment. And a stable political environment really means this. Notwithstanding the fact that the Democrats took control of the Senate, so we have one party control all three houses, they have what Oxford economics would call soft control. They have the ability to effectuate change, but in the words of the real estate roundtable, there are plenty of Republicans and Democratic clothing in the Senate, which will prevent the excesses of the left and, quite candidly, prevent the excesses of the right too. So split government, small majorities is excellent for the economy. Now, a direct silver lining to the flip of Georgia is that we're likely to see more fiscal stimulus. And that is why we saw the material rise in the 10-year treasury in the last several months, because it brings up not only the prospect of more fiscal stimulus, it also brings up the prospect of more inflation. Now, I have been on record in Chicago and elsewhere saying, not only do I believe inflation will be lower for longer, I think it's going to be lower forever. I stand behind that. But at the same time, we do expect to see somewhat higher interest rates than we had expected earlier this year. Now, what I want to suggest is where we are going forward. And so going forward, we think that 2021 is going to be a very strong year for growth, but it's going to be slower than we expected maybe a month ago because the virus has been much harder to contain. And we have downgraded our growth prospects for the first quarter, as has Oxford Economics, as has several other groups, but Goldman Sachs has upgraded there. So 2021, we expect 5% growth, but we expect it to go much quicker starting in the end of the second quarter. Now, I want to give you a real Chicago comment here, because I picked up the phone and called my friend and your Cook County tax assessor, Fritz Kagi, on Monday and talked to him about, well, what's going on? And Fritz, by the way, even though we do expect to see modestly more commercial property taxes because of the revaluation of buildings. Fritz says he expects the, quote, mother of all comebacks in the second half of 2021. And Fritz says you can take that to the bank. I expect the same thing for two basic reasons. Reason number one, pent up demand from consumers. And consumers matter in our economy. Why do consumers matter? Because consumers are 2/3 of the US economy. And if they have money to spend and they want to spend, they will propel us forward. And so they have both. Number one, this pent up demand thing where they want to spend, or as my colleague and friend in Asia, Henry Chin, calls it, revenge retail, wanting to go out and spend. But two, they have money in their pockets, notwithstanding the fact that some people are struggling today, and it's a terrible thing. A lot of people aren't. And the savings rate for the average American is way up, much higher than it's been in decades. And so money in your pocket, pent up demand, people will spend going into the second half of this year. And when I say people will spend, the business community is already spending. I was on the phone yesterday with our global chief operating officer for our capital markets division. We are seeing sales getting almost back to, not there yet, 2019 levels. Now it's still led by multifamily and industrial and some of the sub-asset classes like life sciences, cold storage, data centers. We're still struggling in multi-tenanted office, still struggling in retail, but we have sold a few hotels. And the reason why all of this demand is coming in is because there's a lot of money out there. The amount of money that is signing up to see our deals today is higher than it was in 2019. So a tremendous amount of capital, stability, political stability in Washington, combined with this pent-up demand. We stand by our position of having about 5% growth in 2021 and excess growth in 2022 as well. What are the risk factors? Well, I'm not sure if anybody on this call has a mink coat or not, but there was a mink incident in Denmark about a month ago. What was the mink incident, which I'm sure was top of mind for all of you? The mink incident was that there was a mutation in the disease that caused the mink industry in Denmark to have to cull the herd of 11 million minks. Okay, it is that type of risk that is the real risk out there, that the disease mutates in a way where the vaccines are ineffective. So far, so good, even though there have been mutations in the disease that make it more communicable, and the death of 11 million minks, we are still moving forward, albeit much more sloppily than we would like in terms of the rollout of the vaccine. But it is rolling out. My wife got vaccinated a couple of weeks ago. I'm hoping to get mine a few weeks from now. So it's moving forward. So what does all this mean for commercial real estate? Well, you know the big picture. The big picture is this, is that nobody's in the office. And I was on my phone with my colleagues in Atlanta last week, and they did a survey over the last 5 months. Last 5 months peaked at 7% physical occupancy. They're typically averaging about 5%. And things aren't going to get a whole lot better until people are back in the office. Because what's happening because people aren't in the office? Well, a couple of things are happening. First of all, everybody on this phone call is a commercial real estate executive. Most of you are on the front lines of trying to determine whether or not to renew your leases, to expand your space, to move your space. These are decisions you face every day. And I will bet $1, or at least a plate of eggplant parmesan against some of you, that you are hitting the pause button rather than moving forward. And you're hitting it. Why? Because you don't know. And you know why you don't know? Because I don't know. And the CEOs don't know. Nobody knows. Anybody says, oh, I know what the future is looking like, have them call this guy, because this guy's been studying this issue, not just for the last year, for the last 20 years. And I was on record, on stage in 100 locations saying that office is a want, not a need, for a decade. Doggone it, I was right. But does that mean that people aren't going back to the office? No. Why? To quote my alma mater, Harvard, great companies focus on productivity. They do not focus on efficiency. And why do so many companies focus on efficiency or cost factors? Why? Because it's measurable. That is why so many people are data-driven, measurable. Why are so people put process on a pedestal? Measurable. Productivity, not measurable. but it is the most important factor. And every study we've done going back a decade shows that being in a collaborative joint environment makes you better. Now, don't just take this guy's word for it. I have a study, which I'm happy to send each and every one of you, from Stanford University from 2015, which says exactly that. It says that work from home works from a cost and efficiency standpoint. It does not work from a productivity standpoint. It does not help you attract or retain talent, create a culture. It does not help you get promoted. I mean, this is bottom line stuff, folks. So put yourself in the position of a 25-year-old professional who just graduated from grad school or college. Where do you want to work? In your basement or with people like yourself? I think the question answers itself. The office will come back. So let's talk about the other asset classes for a moment, shall we? Let's start with industrial. So I'm not shy about the areas I've gotten right. I'm not shy about the areas I got wrong. I got industrial wrong. And how did I get industrial wrong? Well, I got industrial wrong because I thought industrial was going to have a bad day at the office for a year. Industrial had a bad 3 weeks. Why did they have a bad 3 weeks? Well, because the market was really shut down in mid-March. After that, it's been the land of milk and honey for industrial. And it's for both for fundamental reasons, because of e-commerce, because of last mile, but also because of capital markets reasons. There is so much money chasing that space that it has pushed down cap rates to record levels. Rents are moving up to record levels. Land is at record levels. But it raises yet another question. Has it been priced to perfection? Is it too good? And so that is a question that was raised on my podcast a few months ago when I hosted a gentleman by the name of Dror Poleg, who's a futurist. And by the way, that will be my first of what I am quite sure will be at least 6 shameless plugs of the Weekly Take, my podcast. So get ready for it, people. But the bottom line is industrial too good? And so many people have reached that conclusion, and that is why people are spreading out their capital to other asset types. And what are these other asset types? Well, I mentioned some of them: life sciences, data centers, cold storage, self-storage, and a call that I just had this morning, single family rental, because that and those asset classes have yields that are in excess of the base asset classes, and they have good fundamentals. Now, what's interesting is that when I got into this business 25 years ago, the spread in the cap rate between these operational real estate and the base asset classes were 200 basis points. Now they've compressed to the level where the pricing is almost the same. So once again, it raises a question: is, are these operational forms of real estate gotten too expensive? But, you know, as my dad would say, things getting too expensive is a high-class problem to have because it's a lot better than the alternative. Now, let's talk about multifamily. Multifamily is the tale of two worlds. Multifamily is multifamily within central business districts or the center cities and everything else. And unfortunately, Chicago is not immune to this. Very similar to San Francisco, very similar to New York, where multifamily is really taking it on the chin right now from a fundamental perspective. Rents are extremely soft, concessions are way up, and to use a fancy economics term on this call, there is no price elasticity. You can't price it low enough. Why does somebody want to spend a lot of money for a very expensive apartment when the restaurant downstairs is closed, when the shows aren't open and their office doesn't let them in? That's why they're moving back to their parents' houses. A lot of people that have the flexibility will do that. That's the bad news. The good news is, because we believe the vaccine will be largely rolled out by June, we think that the summer leasing season, which is critical of multifamily, which is July and August, will be saved. People will come back. The future of multifamily is bright, though the next couple of months are going to be dark. It's going to be very challenging in CBDs, even though in the suburbs it's doing quite well. We've traded several assets at cap rates or at values that are higher than they were pre-COVID. Again, comes down to the fact that the fundamentals are good and there's a lot of money chasing it. But like I said, with industrial, people are looking at some of these alternative sectors, including single family rental, including, dare I say it, manufactured housing. Here's an old joke in the manufactured housing space. When you're selling it, it's called manufactured housing. When you're buying it, it's called trailer parks. That's a real estate joke, folks. The point is this, is that people are looking for yield wherever they can get it. And they're looking for all of these alternative forms of real estate, if that's where they can find it, in part because the yields are better, but also because they've learned how to operate them. Now let's go back to office for a moment, which is the asset class that most of you spend most of your time thinking about. We have traded a lot of offices, and the offices that we have traded and traded well are those that are triple net deals with long-term credit tenants. The offices that we have not traded are those that are multi-tenanted office, particularly those that have a co-working component, because nobody knows what it's worth. Now, the cap rates might have stayed about the same, which they have, if not gotten lower. It is the NOI that is at risk, particularly with buildings with short-term WALTs, weighted average lease terms. Very difficult to trade today. I was on the phone on Tuesday with one of the largest institutional investors in the world, and I tried to move heaven and earth to get them to start to buy multi-tenanted office because I believe it's the best investment opportunity in real estate right now. Couldn't move them. They said there's simply too much risk today about the uncertainty because of these surveys coming out talking about working from home that you're all too keenly aware of. But nevertheless, we believe it will come back for the reasons I laid out before, and it really comes down to one word. The productivity of people working in office is much better than it is working from home. Now, does that mean there aren't going to be more people working from home, or that there's going to be a more agile or fluid workplace, to use fancy terms like we use around here? Of course, there's going to be more of that. There's going to be more hub and spoke, to use another fancy term, more offices in suburbs than there were before. But these offices are not going to be the headquarters. They're going to be satellite offices, and some of that space is going to be flex space. Let me give you a case study. Back in the late 1990s, two large European banks thought they solved the riddle of where to put their office buildings. And you know where they put them? Stamford, Connecticut, which is about 45 minutes from Manhattan on the Metro North train line, direct train line. And these two buildings were right on the train line. They said, aha, this is the answer, because our executives that live in the burbs can drive to work and the younger folks can reverse commute from the city. Well, that went over like a proverbial Led Zeppelin. Anybody know who came up with that line? That was Keith Moon. He was having a drink with Jimmy Page at a bar in London in 1969, came up with the name Led Zeppelin just like that. I guess I'm a little bit older than some of the folks on this call. But in any event, the point is this. It doesn't work having these large corporate headquarters in the suburbs because younger folks don't want to live in the suburbs. They want to live in CBD or urban suburban locations. Why do you think McDonald's moved from the suburbs of Chicago down to the Fulton Market? Because they thought their employees would like it more and get better talent. Google's there. Fulton Market is awesome. The Fulton Market is an example that I use all over the country of how cities like Chicago evolve and why big companies are still going to move downtown disproportionately, even though we have this current trend of people moving into single-family rental and buying homes into the suburbs. So let me turn now to the last two asset classes, retail and industrial. Let me go back to what I said at the beginning of this call. What did I say at the beginning of this call? I said that pent-up demand is going to drive the economy forward by the consumer. And let me give you the best example of that. Who here, by show of hands, and I want to see the hands, who here is getting back on a cruise ship? Am I the only hand up here? I see heads shaking. By the end of this conversation, you're going to be getting back on a cruise ship. So remember, this guy is the research guy, right? Remember that? So the research guy did some research prior to today's call. And what was my research? I went on to the Carnival Cruise Line website. And I said, well, geez, what's going to cost me to take a 3-day cruise from Fort Lauderdale to the Bahamas once they reopen? Anybody want to guess? Anyone? Bueller? By the way, another great Chicago movie, Ferris Bueller. Anyone? $139. You know what the only thing that's more awesome than getting on a cruise ship is? Getting on a cruise ship for free. And you're like, I'm still not getting on that cruise ship. Well, I'm not done with my argument yet. And you know where my argument comes from? It comes from a great 1987 movie called Wall Street. What was that tagline from the movie Wall Street? It was, greed is good. Greed works. Well, I'm here to tell you that greed is not good. Greed has too many negative effects, causes the haves and the have-nots to get further apart. Greed is a bad thing from a social perspective. But here's the good or bad news. From an economic perspective, greed does work. Why? People are motivated by low prices. People are motivated by getting a deal. And you're like, oh, that's not me. Oh, yeah? Well, let me prove it to you. So last year, the ICSC came out with a study and asked Gen Zers, younger folks, people 25 years old and younger, why they buy stuff in malls. And by the way, the Gen Z age cohort is the #1 age cohort that buys stuff in malls when they're open. And there were lots of reasons on that list of why people buy stuff in malls, from being locally grown or environmentally sensitive. And those did come out in the answers at the end of the list. You know what came out #1? Cost, value. Whether you like it or not, people are motivated by greed, which is value, cheap, better deal, better for me. People are getting back on cruise ships, including some of the people on this phone. And I'm coming with you because I'm sick and tired of sitting in my house just like you are. And that's what pent-up demand is. So finishing the argument on retail, notwithstanding the fact that people are going to flock back into restaurants, gyms, movie theaters once they're open again, and cruise ships, it's going to be a bad day at the office for several years for a lot of places. Why? Because over 20% of restaurants are never going to come back. And it takes a long time for retailers to get back into space. So retail is going to be hurting for the next several years, probably not back to pre-COVID levels, at least until 2024. Hotels, no different, but the hotels is the tale of three worlds. Hotels are the international hotels, the domestic hotels, and then the hotel that cater to the drive-to or staycation traveler. I am a staycation traveler. My wife and I just celebrated our 21st wedding anniversary, and every year we go away someplace fancy. Well, last year we went to Vancouver, Canada. This year we went to Charlottesville, Virginia, because it was a 3-hour drive away. And by the way, it was lovely. Nice little wine country there, nice little hotel. And our hotel was full because there's plenty of people that want to do that. So that means domestic staycation hotels will come back very quickly. Office, or rather business hotels, probably not until 2023. And international travel, probably not until 2024. And that means coming back completely. Doesn't mean you aren't going to see incremental improvement in those types of hotels over time. But it's going to be a while. And regrettably, I know that Chicago's hotel industry is really, really suffering right now and will continue to suffer because Chicago is a major, not only business hub, but it's also a major international business hub. So there isn't all wine and roses out there for the next couple of years, even though we are slow and steady going to get better and get better rapidly once the vaccine takes its place, starting in the second half of this year. So let me sum up my comments like this. Assuming the vaccine is what it seems to be cracked up to be, 2021 is going to be a lot better than 2020, starting mid-year. And then it's going to accelerate into 2022 as well. Chicago is a great city and always will be because it has an irreplaceable confluence of highly talented people, infrastructure, and capital. And then there's another factor which I'm now going to add to my conversations about other cities: reinvention. Who here went to the Fulton Market 10 years ago? Nobody. Who goes there now? Everybody. Why? Because great cities like Chicago, like New York, like San Francisco, like LA, like Boston, reinvent themselves and will continue to because of these great factors that will move you forward. So some dark days for the next couple of months until the vaccine takes hold, but a whole lot more good news thereafter. And with that, I'm going to open it up to whatever questions my friends in Chicago have, notwithstanding the fact you did not send me a plate of eggplant parmesan as promised before my speech.
Thank you, Spencer. We will make sure we get that out to you. So if anyone does have questions, please send them in the chat or unmute your microphones and speak up. We do have one question in the chat right now. It is on the retail front. What do you think of medical retail as a subsector with all of the vacant space available?
Well, healthcare real estate and having new types of users for older retail space is a story that's been written for a long time, well before the pandemic. Many examples of healthcare systems, or what they call these little emergency places, docs in a box, have been popping up everywhere. And the fragmentation of the healthcare delivery system from being on the hospital campus to off is a trend that had existed for some time, but might it accelerate today? Sure, it might, because there's a lot of vacant retail space. And so healthcare is one of the users for it. I've also heard about people talking about life sciences being a user for places that are pertinent to hospitals or universities. So yes, it is one of the users that will be of increasing importance as people are looking for users in these space. Another user that that Don did not ask is industrial uses in traditional retail locations. Industrial uses in traditional retail locations could be either for distribution or what I really like, and yes, here comes the second shameless plug for my podcast, is what I call four-wall retail. What's four-wall retail? It's where a retailer controls all four walls. And I know this from my podcast because I had on my podcast the CEO of Agree Realty, Joey Agree, and he said that four-wall retail or hybrid retail, which is the name of one of CBRE's reports, is the future. Why? Because you can have retail in the front and you can have industrial in the back. And if you're a Best Buy, you have services offerings as well. But from a capital markets perspective, the value of the real estate, you also give most of the risk to the operator rather than to you as the landlord. Now, Agree Realty in the third quarter of 2020, last year, remember, the worst year ever, bought a record amount of retail because they believe so strongly in this four-waller, the hybrid model, and I agree with them. Next question. Are you seeing companies minimize their corporate footprint or starting discussions on a strategy to decrease square footage in the future? Is it too soon to tell? Well, I mentioned Led Zeppelin. I'm now going to mention another band. There is a band from the early 1980s called Asia. Anybody remember Asia? God, I am the oldest guy on this call. And so Asia had a song in the early 80s called The Heat of the Moment. And what does the song The Heat of the Moment mean? It means in the heat of the moment, you made bad decisions. And that's what's happening today when a lot of these CEOs are making public statements. And when you're filling out these surveys, we need less space. Well, what we're doing right now is really trying to see the facts on the ground. And the facts on the ground are that there have not been any material changes yet. Have there been some modest changes? Yeah. Have people kicked the can down the road of decisions? Absolutely. But do we have tangible evidence of massive reductions in footprint? No, we do not. Do we have massive evidence of people moving out of the cities and putting new headquarters in suburbs? No, we do not, because it doesn't exist. And I believe that once the heat of the moment is over, people's pendulum is going to swing back and they're going to realize that the CBD has a lot of advantages. And there are forces at play that may de-densify some workplaces for wellness. Other wellness changes include improved HVAC and otherwise. So long story short is it's too soon. And anybody who says otherwise is listening to too much early 80s music.
Spencer, what do you think about rents and concessions that landlords are offering? Do you see any changes in the near term, and what's the long term look like?
Well, I had this conversation twice this week with two large users, and what I did, my answer to that question is market dependent. There are some markets where you have a window of opportunity that's wider than others, okay, where you haven't bottomed yet, or it's going to take longer for you to bottom. So the specific conversation I had was that with respect to this particular client that had some assets in the Research Triangle by Raleigh and Durham, I said, your window there is narrow, meaning that it's the time to strike a deal with the landlord is today. Now, in markets like Chicago, New York, LA, Boston, you have a little bit of a wider window because the market opportunity will be there longer. So to answer your question, obviously, landlords are prepared to make a deal today. But when you look at your landlords, I also want to be specific about this. You have to look at the type of landlord you have, because certain types of landlords will deal more than others. And typically a private owner, non-institutional owner that is in it for the long term for intergenerational wealth or REIT will deal better than will somebody that is an institutional holder that's going to flip the asset. So you should know that it's going to differ by city. It's going to differ by the type of owner, but the time to deal will be longer in Chicago than will be in Raleigh. But if you go to a landlord today in Chicago, and I say this as a guy who represents both landlords and tenants, so I'm throwing nobody under the bus here, you'll get a good deal today.
A couple questions in the chat. They both refer to co-working. What's your thoughts on flex and co-working space?
Brighter tomorrow than it is today. And I mean that not just because we're in COVID. I mean brighter than it was pre-COVID. Why? I know this for two reasons. Number one, we just did a study, and the number one amenity in workplace was co-working, flexibility space. Because most people, and most of the people on this call are corporate real estate executives, know that you always get some measure of excess space. Is it 10, 15% of your space? Is it 20? Something in that range, right? People now want to reduce that excess amount to 5 to 10%, cut that excess space in half. Number one, because sublet space is probably the most inefficient thing in our business. The second reason is co-working is a good solution. And when I say co-working, there's a misconception about co-working. Most people believe that co-working is a bunch of bench style seating with people packed on top of one another. That's not the case. Most co-working is actually demised space or conference rooms. And so what you should keep in mind is that co-working is going to be an increasing part of all of your portfolios rather than leasing excess space either in your building or nearby. And I would add in some of these spoke markets. There's the hub, which is your CBD headquarters, and the spoke in the suburbs. A lot of that space is going to be flex as well. So I think the future of flex is brighter post-COVID than it was pre-COVID. You're going to see a lot more of it. Now, it brings up another question. And so I always think with two of my hats, my occupier hat and my landlord hat. From a landlord perspective, it does scare me a little bit. And why does it scare me a little bit? Because as a landlord, my job is to make sure my building is worth as much as possible. And flex space right now devalues my building if it's above a certain percentage of that building. If flex space gets even bit bigger, is it going to devalue my building further? I think in the short term it does. I think in the long term it does not, because I think the capital markets will adjust once you've seen enough time of people being in this co-working space, generating the income you need for the business to move forward. We all knew that co-working was going to have a bad day at the office during the next downturn, and that was proven to be correct. But longer term, I think co-working's future is bright. I think the whole office space on demand thing is changing. I think industrial space on demand thing is changing. I think retail space on demand thing is changing. And guess what? I had calls on each and every one of those topics with an operator of one of those industrial, office, and retail on demand topics this week. So this on demand thing isn't changing, and it's going to be part of your portfolio. All right. Next question. It seems like cost density was king prior to COVID. Now, it seems like people culture are the drivers. How long do you think it will last? Well, this is to Nat Porter. Nat, cost is still king. All right. I don't want to oversell the culture thing, even though I believe culture is most important, even though I believe productivity is most important. Sometimes when I talk about culture, productivity, or strategic value to corporate executives, they look at me like I'm crazy. Right? Well, they may look like me like I'm crazy anyways, but make look at me like I'm more crazy than I am, because they're not measurable. And that's the challenge today. There is here we go. Now I'm getting on my soapbox. I'm going to tell you guys a data horror story right now. For all you people that say data is everything, tell this story, because this is a true story. So self-storage. I've been doing a lot of work in self-storage recently. And yes, fourth shameless plug for my podcast. I just had a self-storage podcast last week. And so what is the horror story that happened in self-storage in March and April of this year? This is what happened. So a lot of the self-storage smaller owners outsource their management to the big REITs that have big portfolios. The algorithms in March and April said, when the market went to hell, time to drop the rents by 40%. That's what the algorithm says. And that's what they did. The algorithm was wrong. Market demand did not dry up. And by virtue of them dropping rents by 40% in a ton of buildings, they devalued a lot of self-storage by tens of millions of dollars unnecessarily. They were over-reliant on the data, the model, the algorithm. But I'm bummed for all you data fans out there. Listen, I'm not saying data is bad, okay? But I am telling you this. Where did I learn this little lesson? Not just from that self-storage horror story. I learned it from some business guy named Jeff Bezos. Jeff Bezos, you remember him, the richest guy in the world, CEO of Amazon. You know how he runs his meetings? He gives everybody the data and the white papers prior to the meeting. And then when they walk into the meeting, everybody goes into the meeting and tells stories about why they think it's a good idea or not. And then he makes his best decisions. This is Jeff Bezos, right? With his gut, not with his head. Data is an input. It is not the holy grail. All right, so that was my soapbox. Sorry about that. So what else we got here? Second tier
Do you think second? Yep, there you go.
Okay. Do you think second tier cities have advantage over larger cities? Quicker recovery? If so, which cities advantage? Okay, look. I'm going to give you the usual suspects answer, and then I'm going to give you the other answer. You all know the usual suspects. You know Denver, Nashville, Raleigh, Portland, Austin, Texas, Miami, Tampa, Orlando. Dudes, I'm an expert in this stuff, right? But I'm going to give you the counter answer now because I'm an expert in that too. We did studies on San Francisco, New York, and other big cities. Yes, they are going to have a net outflow of people. So is Chicago, by the way. But they are going to have a net inflow of the most talented people, most highly paid people, most highly educated people. And that's what wins the game over the long term. So yes, you have to segregate the market between the macro and the micro when you're looking at these small markets versus the big markets. That said, we are going to have a more diffuse workforce. I told this story the other day on a podcast. I'm terrible about advertising my podcast. So I'm talking with a friend of mine. We both worked in New York in the mid-1990s. You know what my job was in New York in the mid-1990s? I was a young lawyer in a law firm. And you know what that job meant? I was in the office every day from 7 a.m. till 11 o'clock at night, sitting in a crappy little office, eating crappy little food. And then I thought I was king because they gave me a car service home, right? So that's not how the young workers today want to work. They want to live, work, play environment. And I mean, the beauty of Chicago is even though it's cold in the winter, there's a live, work, play environment. It's a great place. But then again, some people would say Denver's better. Some people would say Salt Lake City is better. Some people would say that Miami is better. Okay, so you can't change those factors. So what you need to do is compete for the highest quality talent using the strengths of Chicago, and it will continue to get there. But these secondary cities are going to continue to grow faster than will the old school primary cities. But the old school primary cities will still get a disproportionate amount of the highest quality talent. Next question. The top lessons learned from COVID. How will or people act differently moving forward based upon these leanings? Well, look, we don't know yet is the short answer. The longer answer is I have a fear factor here. Okay. Among my many things that I do is I'm a big advocate for affordable housing. And I fear that one of the outcomes of COVID-19 that they will be more difficult to build affordable housing in suburbs rather than less moving forward. It's already been extremely difficult to build because the segregation between haves and have-nots has just been horrible over the last 20 years. It's only gotten worse. Now people are going to use density as an excuse as well. So that's a little bit of a side note. I fear that COVID is going to be used as an excuse to just make us more of a segregated place. But what are the economics lessons learned? I'll give you one of the lessons learned. Thank God the government pumped as much money as they did into the economy. It worked. We're still in a bad place, but Lord knows we would be in a lot worse place if we weren't. So the lessons of the GFC, of the Great Depression, were paid back to us, and we're better for that. Other lessons? Look, if you thought I was having an esoteric conversation before, on my podcast that I recorded yesterday, I had a debate about democracy. Say, oh, this guy going to talk about democracy now? Look at China. Okay, not a democracy. They wrestled the disease to the ground. Is it perfect? No. In America, our democracy worked against us during this crisis. And I would hope that we would find a way to make democracy work in a time of crisis. Look, 9/11 was horrible, but at least for a nanosecond, America came together. COVID-19 tore us apart. So I think one of the lessons learned here is that we need to figure out how to make our government work, not just in the economic crisis, but medical crisis like this, because right now it does not. All right. Chicago sublease market continue to climb or level off. Well, I think it's going to climb a little bit, but I think it's also something that can turn off like a switch. The beauty of sublease, it could be turned on and could be turned off very quickly. So I watch that market for signs of weakness, but nevertheless, it can be turned off like a switch. And I expect once people are occupying office again, it will be turned off like a switch. Next question from Patrick Slarity. Thank you for your thoughtful and timely insights. You are the best speaker ever. He didn't say that there. I just, In addition to the long-term implications of the rise in turnkey spec suite workplace solutions, do you see long-term resiliency in new development or multi-tenant life sciences hubs, primarily targeted to startups, modular lab? Thank you. Looking forward to the next podcast. See that? I didn't even say that time. So I'm going to give you the good news and bad news of this. Yes, I just had a podcast on life sciences, and I just spoke to that guy just prior to this call. But the bottom line is the entirety of the life sciences business is 140 million square feet. That's it nationally. The whole country, all of it. That's smaller than Chicago for those people who are adding up the total amount of office space in Chicago. So no, it is not the solution, unfortunately. It is a good niche solution. It is going to work in places that are near hospitals, particularly research hospitals, and other top universities. But no, I say this even though Patrick threw me a great compliment, and I'll take the compliment. Thank you, Patrick. I don't think it is the solution because I think it's just too nichey. It's just too small of a space to be a big solution for our industry. I think the solution in our industry is fixed multi-tenanted office because that is the area that is by far the largest segment of our commercial real estate economy and where I see the greatest opportunity.
Spencer, I want to circle back. I think we skipped over one. What amenities, perks are you seeing organizations implement to get people back to the office? Do you believe they'll invest in satellite co-working spaces to cut down on commute and service employees that are located in many different areas of Chicago?
There is going to be more hub and spoke. There is going to be more focus on wellness. There is going to be more outdoor space. And that brings up outdoor space, by the way, was the #1 amenity in Manhattan pre-COVID. But here's the problem with outdoor space and operable windows. And this is an earmuffs moment for all of my people with green thumbs on this call. It is, there's going to be a conflict between sustainability and wellness for a while. Because did you know, for all my LEED certified people on this call, that if you have operable windows in your building, you get a demerit from the LEED people? Who here doesn't want, if there's nobody on this call that wants to get on a cruise ship, I'm sure everybody on this call wants more fresh air in their lives going forward. Okay? So there will be this short-term conflict between sustainability and wellness, but we'll figure it out. On my podcast, yeah, that was my 6th reference. I had the global head of real estate for Microsoft, and we talked about that. They're going to solve the problem. But in the short term, it is going to be a problem. There is going to be this rub. So did I answer that question? I'm trying to see. Oh, the amenity. So the amenity is going to be outdoor space. It's going to be fresh air related. And there is going to be more spoke as it relates to co-working space in suburbs. And people are going to be working in the office instead of 4 to 4.5 days in a week, 3.5 to 4 days a week. But some people are still going to be in the office 5 days a week. I personally have been in my office twice in the last week, which is the most I've been in the office in a long time. And you know who was in the office? And I just say this matter of fact, is not to slight anyone. Our most productive teams were there. They were there. And in terms of the highest producers and their teams and that sort of thing. And so I see that as drawing other people back to the office as well. I think the biggest incentive to get people back into the office is to see people that you respect going back to the office.
Great, thank you. Matt Porter, he's asking you if you've ever thought of doing a podcast. I think he's maybe joking.
Great idea.
That's all the questions we have coming in. Spencer, once again, you've enlightened us. You've given us something to look forward to this year after a fairly dark 2020. So thank you again for coming and speaking to our Cornet Chicago chapter. It's always a pleasure having you, and we're definitely going to work towards getting you that Maggiano's food you're longing for. So
next year in Chicago.
Yeah, hopefully in person.
Yeah, it will be. It will be.
Yeah. Yeah. Well, thank you so much. Thank you, everybody, for participating today. Look for our other events that are coming up, and go out onto the Coronet site and register for those. Have a great weekend and the rest of the week. Thank you.
Thanks, Barry, everybody.